Hey, good morning, traders and investors. Welcome back to the TA Live Wednesday live stream show. I'm your host, Bennett Tyndall with TradingAnalysis.com. Thank you for taking time out of your morning to join us. It's been quite an interesting start to 2022. When we met last, we talked about the possibility that the indexes could push back to those December lows and potentially even break through them before finishing the correction, which we believe originated back in November of last year. So, hey, we're going to run things just a little bit differently this morning. I'm going to take you quickly into the charts. We're going to hit you up in the Motive Wave platform. And I just wanted to illustrate kind of our view here in the NASDAQ. So let's jump into it. Looks like, yeah, there was, for those of you curious, I just got a couple of messages. We are in the process of changing up some graphics and some renders here at Trading Analysis, and the intro music was most certainly missing. So not just on your end, that was something you're going to have to live with for just a week, but we'll be back with something fun next week, I promise. Okay, so hey, traders, investors, thank you guys again. We appreciate it. Let's jump into it here and kind of talk about where markets have come over the past week since we met last. When we met last, we discussed the possibility in the NASDAQ, in the S&P, in the Dow Jones, well, specifically the NASDAQ and the S&P, we discussed the possibility that, in fact, we were still contained within a corrective trend that began back in November of, gosh, this is now last year. From that November high in the NASDAQ, we pushed lower in three waves. And I've continued to kind of reiterate the fact that we need to celebrate the fact that this overall structure is, in fact, corrective. And we don't view this to be the start of a larger bear market trend. So we pushed down into the December low. From the December 3rd low, markets rallied higher in three waves. What does that tell us? Well, that tells us the end of December high could not have finished a motive trend, which means the next corrective leg lower should be an entry opportunity for investors and traders. Originally, we had the possibility that, in fact, that December 20th low finished wave C of this overall wave 4 correction. The alternate, and we knew this was the case, would be the fact that we're contained simply in an Elliott Wave flat. 3 waves down, 3 waves back, and another 5-wave decline. So what sparked the volatility? As you can see here, I've got January 5th noted. January 5th was last Wednesday when we met for the live stream. And as we discussed during the live stream, we had the Fed minutes, the December Fed minutes that were due out in the afternoon. Typically, for those of you who are new to markets, the Fed minutes are generally a non-event, and it typically simply echoes the sentiment that was communicated at the actual or in the actual press release, as well as the press conference that followed. But there were actually a few surprises in there. We saw a bit of a hawkish pivot from the Fed. No longer was it a wait and see attitude. And in fact, there were a couple of key items that kind of flustered investors, if you would, specifically the fact that they are looking at the possibility of 3 hikes in 22. And in addition to that, they're also anticipating the majority of committee members see the need for balance sheet runoff following the first hike in the federal funds rate. So clearly that sparked some volatility that continued to the downside. We continue to remain bullish and anticipate a resolve to the upside into new highs for the indexes. And we're not going to buy into the kind of the bearish narrative that much of the financial media started to cast following those Fed minute release. So it has yet to happen. The situation is very kind of dynamic. We knew the easy money policies of the past 2 years would be coming to an end as the economy recovered from the coronavirus pandemic. The pace of said recovery is still yet to be determined. Obviously, we have the Omicron variant. We've got CPI out this morning. So we're going to take it one wave at a time. But strictly from a hard right edge pattern interpretation point of view, this is not the start, in our opinion, of a larger market decline. So we're going to get to the charts in just a minute. Before we get to the charts in greater detail, let's go ahead and bring in the trading analysis team. Good morning, Terry. Good morning, Alex. How are you guys doing?
Morning, guys.
Hey, guys.
Yeah.
What's happening?
Another lovely day in paradise. How about you?
I'm doing well. We got some rain over the past couple of days. It's interesting weather here in Texas. How are things in Serbia? Alex, how you doing?
I'm great. Much of snow in the last couple of days, so people skiing are very happy. But I live in a border of a town, so cleaning guys, which are taking care of our streets, are still not in our neighborhood. So icy streets. I love to drive on icy streets, apparently. So I had a couple of drives last day, and it was fun. It was fun. You roll around, all
I,
that sort of stuff.
I could see you having some fun on the ice, man. That's
Yeah.
I enjoy getting out, and I've never lived in the snow, and they always say if you visit the snow, you love the snow. If you live in the snow,
Yeah.
you hate it. So
Well,
hopefully I never live in it. But hey, so what do you guys think about this the Fed minutes from last week? I mean, if you look back to November, we knew the tapering started November, 15 billion off the 120 billion of bonds and mortgage-backed securities that they were buying. That doubled to 30 billion in December, and with the potential 3 hikes this year, they're penciling in 3 for 23 and another in 24. What's your opinion, Alex, Terry? Either of you guys, any thoughts on that topic?
Yeah. Terry, would you like to go first, or I'm going to say
no, you
what
go ahead,
my
Alex.
Okay,
You
so
go ahead.
I don't have a view they will hike 3 or 4 times this year. That's my view. They're gonna hike one, and they're gonna definitely reduce to zero quantitative easing. So in March, as you can see on a Fed CME tool, there is already 82% of a chance market is pricing a 0.25 basis points rise. Stock markets can handle one increment of rates on the upside. 0.25 is not really a big thing. The question is to carefully monitor what's going on with inflation, and if we see inflation backdrop slowly going, as I think this is the last COVID outbreak with this Omicron, as the virus is diluting itself strength to spread more and more to survive. So I guess, I mean, my take will be we are going to be out of this pandemic in June, July 2022, I hopefully, and it will decrease in strength. So while the economy balances itself, as well, we have to take account some global geopolitical events, but I don't see Fed hiking 3 or 4 times. One, maybe 2 this year. That is all that I'm seeing with the current data and the current sentiment.
Okay, yeah, and that the path of the hikes very much so, not written in stone, nor is the path of normalization or the pace of normalization. So I think that reaction, the move to the downside, we continue to view as an overreaction. Would you guys agree?
Yeah, the plan that they've laid out, I mean, they're giving the market plenty of time to price in the anticipated effects of those moves. And then if Alex is right and they actually don't do as much as they anticipate, then I think everything will be all right. But for the most part, I believe first half or more of this year is going to be choppy and indecisive. That's typical in a second year of any president's term. So the midterms will be coming up in the fall and things like that. So, but yeah, from the Fed, I just have an expectation that they're going to do better than Greenspan did back in 2000. Definitely. Because he got slap happy with interest rates and he raised rates so rapidly, so many times, without giving the market time to absorb the move. He over corrected, and then he collapsed the market. Then he had to rapidly reduce the rate. So he did the yield curve inversion, and that'll be the thing we'll be talking more about as once they start raising rates. We'll take a look at that, because the Fed can manipulate the short-term rates, but the market has to manipulate the long-term rates. And if the Fed just jacks the short-term rates up too high, then you get this yield curve inversion versus the long term. So that'll be more to come on that.
Yeah, you get actually the yield curve inversion, especially if they go out of the QE program, because in general, if you see, I think it's, I mean, if I put myself in their position, it's very difficult to predict anything. I mean, you can have a span of data fluctuating of a couple of one standard deviation of your normal data where the economic situation is normal. But I think also they were surprised by inflation to be such a persistent phenomena. And I think they're still kind of looking where this is the end, or where the inflation slows down and in what circumstances. So I think it's very difficult really to see the future now. Everything is kind of fluctuating in the ranges not seen before. Extreme moves of inflation on the upside, supply chain problems, all sorts of other things. But from the data we have now, as Terry said, first half of 2022 might be also in inflationary manner and fade out towards the rest of 2022.
Absolutely, very well said. And speaking of inflation, we did get CPI print this morning. Core coming in with 0.6% increase versus the 0.5% they were looking for in the forecast, and the headline 0.5% versus 0.4 that they were expecting there. So it is going to be, in our opinion, a bit of an interesting year. We feel sector rotation is going to be very key in this market. We'll likely see some rolling rotations. We're seeing some interesting improving conditions in value. And we looked at that value growth rotation dynamic last week. Terry Long will be in just a few moments to take you through the sectors in Optima. All right, so good start. Let's go ahead and jump in here. Taking a look at the futures market. Futures are sideways to higher following yesterday's close. We're up a good 20 points here in the S&P futures from yesterday's close. So it's going to be an interesting day. Very curious to see if we can get a bit of a brief retracement to confirm this uptrend, and we'll be looking to get back at it. Speaking of confirming uptrends, the Monday morning, so on Monday when markets gapped down, and based on the structure, we were expecting a gap to the downside, or a move to the downside. We weren't anticipating a 1% gap, but it fulfilled the structural requirements to begin a mode of reversal on the upside. So we put some capital to work with our members, put our money where our analysis is, and we're going to take it from there. All right, so I'm going to take them through the charts in the Motive Wave platform. Boys, I'll be back in just a minute, and we'll carry on from there. Catch you guys in just a couple. I told you we're having some technical difficulties this morning, so just give me a break, all right? Hey, I appreciate it, guys. Thanks for tuning in. Let's hit it. Hard right edge of the Motive Wave platform, one of two key tools we use here at Trading Analysis, including Optima, which Terry will be in to take you through in just a few minutes. So hitting it up in the NASDAQ 100, I'm taking you right to the daily chart. We're going to look at the daily chart for starters. And looking at the daily chart in the NASDAQ 100, there's been a bit of a debate amongst the Elliott Wave community in terms of where are the corrections of the same degree. There's been a lot of overlap, at least through 2020, in through March through September. There's a lot of overlapping corrections. As a result, the subjectivity of the count increases. With this in mind, very early on in 21, we kind of took a step back and said, you know what, we're going to use Elliott Wave to dissect the underlying collective sentiment of the markets by analyzing the pattern developments. And we're not going to focus so much on the higher degree wave count. We continue to view the higher degree wave count as moving from the lower left-hand of your, bottom left-hand corner of your chart to the upper right-hand corner of your chart on the daily and weekly charts. And we continue to feel that this is just a correction. We do not see this as the start of a motive trend to the downside. So looking at the NASDAQ, if you just take it back to Elliott Wave 101 and look at 5-wave progressions and 3-wave pullbacks, we get our first 5-wave rally into September. From the September high into the September low, we correct lower in 3 waves. Then we rally again in another 5 waves, and we correct again to the downside in 3 waves. From there, we have a nice 5-wave move. Going back to November 9th of 2020, I remember the very first positive coronavirus vaccine news that we had. Gave markets a nice gap up, confirmation retracement, and we continued. What I want you to notice about this trend is the wave 3 meets the 1618, the wave 4 pairs up to wave 2, and from there we get the more discernible 5-wave structure. So in my opinion at least, we have an extended 5th wave into the November 22nd high, and that extended 5th wave has some very solid high conviction fib at work. We've got 4v2 equality, we've got wave 3 between 100 and 138%. When that occurs, that tells us to expect wave 5 to be about 61% of 1 in 3. That's exactly what happened. In addition to that, if we take our Elliott Wave channeling technique, which includes utilizing the low of wave 2 and the low of wave 4 to establish a base trend line, project your parallel trend line over the top of wave 3, when you use that in combination with your wave 5 fib objectives, you often narrow down where that market is going to come to a high and be met with a correction. So there's the November 22nd high. And from there, we continue to view this as a wave 4 pairing up to the wave 2 pullback from September of last year. Looking at this in the XLK has that same high conviction wave structure at work, in that the March through September 2020 move has a lot of overlap. We have a 3-wave pullback, another 5-wave move, 3-wave pullback. We rally, we pair the correction, and then we go into this big extended 5th wave. The big extended 5th wave has pretty much the same fib at work as the NASDAQ 100, which is not too surprising given the components within the NASDAQ 100. We pair up wave 4, wave 5 is equal to 61% of 1 in 3. That takes us into the November high, and we have now been in a period of consolidation, Elliott Wave flat correction. So we view this as wave 4, and we do expect a Q1 rally to continue prior to a potential 10-15% larger market correction. I don't see a larger market correction that would exceed anything that we've seen from the COVID lows possible from a technical perspective until we complete this 5-wave rally into new highs. So I'm going to continue to remain bullish. Going back to the discussion I had with you last week when looking at the growth and value rotation and the outperformance of value compared to growth, RRG is all relative performance. The idea that we see value outperform growth in wave 5 of a major 5-wave move is not unheard of and not uncommon. And as a result, we're going to continue to explore other sectors that don't typically see as much attention as your discretionary and tech names. So here in the NASDAQ, let's get off the daily, take you back to that 1-hour chart, because I do think yesterday we have a very strong chance of having inked out, finished that wave 4 correction, now setting us up for mode of resumption. This is my best case scenario outlook in the markets. Wave 4 is over, we're going to continue to rally from here. What's the worst case? Where could I be wrong? And if I'm wrong, where could we go from here? Well, first, just let me clear my fib ratios here. And let's, for a minute, separate ourselves, as I talked about at the beginning, from the wave count. And let's look at the pattern. Let's look at what the pattern is telling us and what the pattern Fibonacci relationships are. When looking at the pattern here, you'll notice we have a move down in 3 waves, we have a move back in 3 waves, and we have a decline in 5 waves. That's a standard 3-3-5 Elliott Wave flat progression. And when looking at an Elliott Wave flat progression, there are 2 common C wave fib objectives. The first, equality of CNA. That came in at 15,397. The next most common C wave objective is a 1272 external retracement of the B wave rally. That gives us a zone of support near 15,625. The move Monday took us down to 15,165. It's worth noting, as we made that new low on Monday, we had positive internal divergence, which suggested that was rounding out the low. That's where we put a position to work in Microsoft and got in front of this multi-day decline. So this is the best case scenario. Marcus just completed that 3-wave move. Now, where could I be wrong? Another very common fib target in a correction is, first of all, a retracement of the motive wave that preceded it, and then also a comparison to the magnitude of its wave 2 counterpart. If we take that into consideration and bring in 4 versus 2 equality, we'll see 4 versus 2 equality is down at 14,390. Simply put, that means the wave 4 correction would be equal to the wave 2 pullback from September of 2020. Now, wave 4s, when they alternate to a wave 2 zigzag, typically don't see that significant of a decline. We don't typically see 4v2 equality. We more commonly will see about a 6-1-8 relationship, which for some reason that fib is missing here. Let me go ahead and include that, see if we can get it to pop up. So there you go. The 61% relationship compared to wave 2 was right into that clustering of fib. So best case, C is over. Worst case, C is still ongoing, and we could move down to those lows. One thing that would have me confident to enter the market if we were to sell off to that level is the fact that 4v2 equality does have confluence with the previous fourth wave of one lesser degree. So we're bullish. We continue to view this, actually 2 lesser degrees. We continue to view this as wave 4. Going back to the subjectivity of the wave structure, let's look at the Russell 2000. Because looking at the Russell 2000, this is one index, I feel, that leaves no room for alternate interpretations. I feel, without a doubt, we have paired up the wave 4 and wave 2 corrections, and we're likely moving higher in wave 5. If I'm wrong here, and we see a breakdown in the Russell 2000, that would be a bit concerning, but I don't think that's the case just yet. So there's a lot of evidence to substantiate the fact that we're going to rally in Q1 and potentially see a larger corrective pullback mid Q2 or early Q2, very much so not written in stone. So that's my part for today. I also want to take you over here to the Dow Jones. Looking at the Dow Jones Industrial Average, which is an index we typically don't track, believe it or not, this 30 stock index was the first of the indexes to say, hey, look, this is a correction that's complete and it's time to get long. And that correction completed, in my opinion, for the Dow back in December, early December. We have a 3-3-5 Elliott Wave flat progression, very similar to what I just showed you in the NASDAQ. We rally higher in 5 waves, correct lower in 3 waves, rally higher in 5 waves. Notice the similarities between this wave 2 decline and this wave 2 decline. So this is the child wave, this is the parent wave, this is essentially, in my opinion, a fractal of that higher degree corrective retracement. So not going to buy into the bearish sentiment that some in the financial media were expressing following last week's, earth-shattering Fed minutes, as many expected it to be. I don't think that it's going to impact the validity or the breakout potential here in this wave 5. So that's it for me. Let's go ahead and jump back over to the trading analysis team. We'll get there. What do you guys think?
Very good, very good. Yeah,
what do you guys think?
There
Wave
was
4?
a lot of Fed support that showed up around that 15,165 level. I don't think we're the only ones that identified that, but that certainly just expresses my belief that we're on the right track here with the reversal.
Absolutely. All right, Mr. Terry Long, what do you think, Alex? What do you think about that wave 4? You think we're going to get the new highs?
I mean, in regards of that, very possible. But I will just state something that we have been emphasizing a long time ago, until we see clear signs that the reverse, at least on higher time frames, has produced a clear 5 waves down without the option that is a possible flat. We don't have any reason to believe that the stock market is turning lower. So, I mean, from my perspective, clarity is pretty much over there.
Yeah, very, very, very well said. And, it kind of echoes in our sentiment last week that we expressed to our clients that a continuation lower would be a shakeout move. Monday continued that shakeout move with some volatility, an hour of selling pressure out of the opens, but we've bounced back, and we've seen about a 4.5% move from Monday's low into yesterday's close for the NASDAQ. So quite the bounce there. All right, Terry. Yeah, go ahead. I'm sorry.
Just small observation. When you have this type of volatility in decisiveness, and you go back and forth, you have to have a clear signs that the pressure is winning while the pressure is resisting on the upside. So clearly, as long as we see the run from the 2020 March upside, we have seen only 3 waves correction. So, I mean, the pressure on the downside is still not strong to produce anything reliable that you can say market is going lower. So I think from my perspective, that's very easy to observe if you follow just the simple Elliott Wave rules.
Absolutely, absolutely. I apologize, Terry. Your content's just too good. I had to take a little there. All right, let's hit it. He's going to take you through sector rotation. What's up, Alex?
I'm in the mood today. Okay.
I love it. I love it, brother. All right, Terry, take it away. We'll be back on the other side, and then we'll carry into macro with Alex. See you guys in just a few.
All right, thanks for that. Hello, traders. I'm Terry Long at tradinganalysis.com with your weekly sector focus. Now, the market started out this week with a continuation of a corrective move from the year-end all-time high levels that we set. We saw a sharp dip and reversal move back into positive territory for the week. Look at the wick here on the candle, on Monday's candle. I think that's very interesting that we wicked down, gapped lower, and then shot back up for a positive close for the day, positive close on Tuesday. So these long wicks reach down and test for and clear out support levels below. Now, prior to that, we were floating right at the 50-day simple moving average there for the S&P. Right now, last week we were down 1.87%, right? That's a pretty hefty down move. Now we've recovered 0.77 on the upside before the market opens here. Then looking at the NASDAQ here, yeah, he was stealing my thunder because last week we lost 1.7% on the S&P. We lost 4.46 on the NDX. So it was a much deeper push, and indeed the NDX actually pushed well below the 50-day moving average. That's this blue line here. And penetrated below, but the response was very similar. We also got a wick lower, a move back to the upside, 2 positive days back in a row there. We're up a 1.62, which is double so far the move of the S&P. Now, the interesting thing, I want to jump over here real quick. Let me go ahead and talk about this. This is last week's price performance. So last week, look at this zoom up here. The energy sector exploded 10% higher in a massive breakout move from its most recent consolidation. And it is continuing to move higher this week. We'll move that out of the way for a second. I'm going to jump over here to the chart of the XLE and show you this. I had been trending the XLE in a corrective move coming off of November 8th. In a downward trend. We started to think that we had the end of a ABC correction, possibly here December 20th, as we saw energy bounce off the 200-day moving average and then start to rally back up. But we really didn't get a confirmation that something was evolving in a impulsive move, because we could have just as easily drifted lower here. But on Tuesday, January 4th, we saw a thrust upward with a high wick and then a pullback, and then followed that by Wednesday, Thursday, Friday, just continuing. The whole week just shot straight up. And you can see the 10% move here last week. And if I stretch this up a little bit more to yesterday's close, the energy sector is moved up 12.4% all from the Friday 2021 close. So it's been a big move there. I will say, though, that if I zoom out a little bit, you can see all these red lines. These are long-term. This is a long-term downtrend that extends from the July 2014 high through the October 2018 high. And you can see that our price is just right there in that zone. It's also, I have a medium-term uptrend here that extends back through a series of recent highs dated, let's see here. This is June, this is March, and we have that. So we're reaching this confluence of resistance zones. We did penetrate above, interestingly, above that long-term downtrend just a little bit, and we're still riding in the upper zone here of the medium term. So yeah, definitely big move happened there in energy. And look real quick at the relative rotation graphs. Let me back this up, and I'll back it up to the close on December 31st, 2021, where we had been tracking all of these vectors to this, pushing to the south all the way up until we got the first week of the new year closed, and then we got positive reversals. You'll notice that all of those red vectors that were pushing lower, we started to get a hook back to the north, and many of those vectors have also turned blue again. Several of the leaders like Devon Energy, Fang, and ConocoPhillips that had pushed down here into the weakening quadrant, they're also playing around with some reversals, but their price charts are less affected by the decline, those with the higher relative strength, than the ones that are over here on the left. So going from right to left, read the highest strength to the lowest strength, but you're getting some big reversals now in energy. All right, let's move back here real quick to the sectors and take a look at this. The financial sector, this is another one interesting to talk about. I did change my layout just a little bit here. The financial sector had been pushing down into the lagging quadrant, rapidly moved. It did barely spend any time here in the weakening quadrant. It went straight from the leading across the origin down here into it, but we have seen a rapid transition, a hook back to the north there, formed in the XLF, and a continuation of that. So the financial sector is another one that's also had a big move. It rallied 5.4% last week, but on the downside last week, we did have real estate, healthcare, and technology sectors. Let's take a look here at the vectors. You can see the energy. This is the energy vector right here, which had been pushing to the south. You can see the reversal hook there. Energy wants one more trip right back up into the leading quadrant, it looks like, before finishing what might be a fifth wave. And we'll have to watch it the next time. I believe the next time this one rotates south, that might be it for energy. Energy might be topping. Okay, the weakness in technology is not really in terms of relative strength as much as just simply momentum. You can see the change, a little bit of hook formation there back to the south as technology is holding a good strong position in the leading quadrant, but is now pushing closer towards the weakening. Discretionary is fading a little bit, but here's the real estate market. So real estate also took a little bit of a hit. Pullback of about 4% last week. Real estate had pushed itself up here into the leading quadrant, and the only thing that we really see out of the effect of it is I see a green vector turn to yellow, which tells me the price trend in the XLRE is weakening just a bit. The materials and real estate are the newest entries we have here into our leading quadrant. So opportunities for trading the stocks inside this is certainly on the table. Additionally, the staples sector, which is, we rarely talk about it because it's not much of a growth sector, but the staples sector has perked up a bit. And I'm sorry, I got some errors down there in that, but we've got a lot of stocks here in the improving quadrant wanting to move over into the lead. So that's about all I've got for now. I think the wild trading that we saw here in the S&P and the Nasdaq, that's probably going to continue on. That's called volatility, and we'll just have to play with that. So let's see. I did forget one thing. Let's go back over here. Communication sector. I see it on my notes here. The communication sector is also one that's been weakening, but we are starting to see a lot of momentum move right back here into the communication sector. It's not fully confirmed back to the northeast just yet, but we're going to keep our eyes on what's happening there in the communication sector, certainly. All right. So let's see. I think that's about all I want to talk about, Bennett. Hey guys, in this new year, I encourage each of you to join the Trading Analysis subscriber base. Now, Bennett and I will be putting together a new series of swing trade portfolios for our clients, leveraging our expertise and our foundation using these relative rotation graphs, Elliott Wave theory, and in combination with other reliable technical analysis tools. Now, I think 2022 will likely prove to be a more difficult year for the average trader or investor to navigate. Join us and let us help guide you to becoming a more successful trader. Back to you, Bennett.
Much appreciated. Thank you so much, Terry. Very curious to see what communications does there. You know, communications and the Russell 2000, I think those are the only two charts that kind of challenges my Q1 expectations, but I'm not going to let that derail my dominant market sentiment. So excellent work there. We'll continue to track that. As Terry mentioned, this year is probably going to look a lot different with the expected Fed tightening and potential balance sheet runoff. We've got a lot of good products already at work. We've got a lot of ideas and new additions to the service underway. As mentioned, the stock swing trading portfolio, we're going to utilize a combination of RRG, a little dash of Elliott Wave, and then of course some traditional technical indicators to transition through sectors that are moving from improving to leading quadrants, rotate out of stocks and sectors moving from weakening to lagging. This year is not going to be a year, we feel, where one can just buy all the growth names and sleep peacefully at night. It's going to be a little bit more challenging, and it's going to require a little bit more oversight and rotational analysis for sure. So thanks again, Terry. Excellent work as always. Alex, what's up, boss? We're going to pass you presenter mode. If you could take us through your macro outlook, curious to see what you think about the move in 10-year yields. We've been expecting a breakout higher there. The move in crude oil has been quite interesting. We had brought your attention to the fact that crude oil actually reclaimed a decade-long downtrend resistance line, flipped the script, and turned it into support. So curious to see if this turns into wave 5 and we finish a rally or not. So you ready to rock? I think we've got presenter mode your direction.
Yeah.
All right, take it away,
yeah,
and we'll be back on the other side.
Hey guys, let's look a little bit of macro scene. Let's go and see a little bit of what's going on in gold and silver, and also in Bitcoin. So in general, our perspective from all three of us as a trading analysis team kept a consistency during the 2021 on the fact that we have seen rates going higher, and for now, this scenario in the rates as in the dollar is pretty much developing nicely on the upside, as we thought it's going to. Looking this wave structure, there is a couple of possibilities, but I emphasized that first we have to focus for this level around 2%. So where we're going to get equality between these two legs. Rates are not moving so fast, so this can also turn into some type of a triangle, but that's not really important now. I will be focusing more on this 2% level. If we go substantially higher and break this level, then we have to transform this into a more impulsive wave on the upside, which will have definitely its implications on the different assets classes. But for now, as long as we trade in this range, as you can see, that there is a pretty much a range between 1.11 and 1.7. We stopped once, twice, and now we are stopping third time at that. So maybe we're going to go in a little bit more of sideways. Maybe we're going to continue on the upside. But for me, key level is 2%. I'm going to be focused what is going on there and what will happen post March meeting. Will the rates with the current Fed outlook will continue higher, or they're going to actually endure some type of a pullback. So we are still hovering around this 1.7. So let's see what will happen in the next weeks. Rates are moving higher. Let's see how that will unfold. So takeaway from there, 2% is the key level, and we will go from there. In the European front, pretty much the same picture as we were looking for already a couple of years. I'm tracing these 10-year bonds, and that's kind of what gives me also a takeaway for my thinking that this inflationary pop is just a couple of years event, like a cyclical more than secular event, I'm really looking this to be a complex correction. My support levels are at 157, 158. This is the price of the 10-year bond. I always emphasize that yields are inverted, but it's easy to manage that. This is just a clearer wave count, and that's why I use it. So in that respect, we still don't see any impulsive wave structure on the downside. This looks pretty corrective from the view of the Elliott Wave practitioner. So I will not take any bullish side on the rates on the upside. I just think this is going to be a consolidation for 2022, maybe even a beginning of 2023, and then from there, due to either some global geopolitical event, we are full of that nowadays, of geopolitics and what's going on in China, Russia, and all around the world, especially in a couple of places where the tensions are high. Iran, and mostly everything of that is in the news. Or economy balance itself, supply chain starts to work, prices move a little bit lower, and deflation is off. That will create a secular forces of demographic and technology to kick in again. These processes usually takes a couple of years, and I think that what is people omits from their thinking. Macro elements are a very high time frame elements, and they're moving slowly. And usually when you have this trend reversal just in a corrective manner, they can take a couple of years to unfold. So you have to widen your horizon and the time frame when you're thinking about these things. And yeah, this will be my support level, and due to this two factors which might kick in 2023, I think the deflationary scenario will kick in again, and we are going to see rates moving lower and the price of the bonds going higher, especially in the Europe. So let's move to dollar index. Also, a nice coverage towards 2021. Dollar is moving lower now, as you can see, and there is a couple of levels which we don't like to be surpassed for this bullish outlook. I have a debate with Terry. Should we consider this equality as a possible highs, or we are going to see a dollar higher? I still don't know. As I said, on the stock side, even on the dollar side, my view, when you have a potentially corrective wave structure, this was clearly a 5-wave move with a small truncation, is that I'm going to wait for a 5 waves move down and go from there. For now, we don't see that. Is it possible that this was just a small ending diagonal fifth wave here? Yes, it is. I will not have any subject to that. Then we stops around equality, but I will leave the open space for the dollar to move one more move to higher levels until this levels exactly around 94.50 is breached. That will change a little bit my picture. The RSI on daily kind of matches with the deeper wave 4. So I would like to wait a little bit more until the situation gets more clarity. And for now, until we see clearly a wave count invalidation, I will more likely to be on the side with one more upside move in dollar, while these levels of support and the levels of one of the Elliott Wave rules, that wave 4 cannot enter the territory of the wave 2 or the highs of the wave 1, depends how you take it, is actually happening. So watching this RSI and the current move, I would maybe think that we might see a reversal, one more move on the upside, maybe February, March 2022, and then possible 5 waves down, because on many aspects I see 2022 and possibly beginning of 2023 as the dollar lower outlook. I will be looking for dollar to move lower. I'm just waiting the signs for that. And I see that on a couple of currencies, especially commodity currencies around the spectrum. That and also you can see that on gold, silver, Bitcoin, and a couple of other assets classes, which are kind of a foretelling with their structures that dollar might be in trouble in 2022. So let's see. Also, one chart which I've been sharing with the members of Trading Analysis is this soybean chart. So we have been presenting that to our members for a potential correction down in this 50%. We have looked for a move up. It's still not a 5-wave move, but looks like very impulsive in the 3rd wave. So potentially, if we get a 5-wave move, that will mean that most likely we have completed this 4th wave in soybean, and that we are going to continue higher. As the oil is concerned, I think I talked about that. Let me just find that chart, and we have deal with that. I think last time. Yeah, so I've been looking for some type of a move on the upside, especially if we start to consolidate on the higher time frames. I cannot find the chart now. I didn't even wanted to talk about oil, but in general, I will just mention this, that there is a probability this is some type of a bigger complex move, and definitely there is a chance we go to up to the next resistance and even higher, and this may be a 3 waves down, flat in 3 waves up, and then we get a sudden move on the downside. So potentially $100 is in hands here in a possible 5th wave and even higher. So oil doesn't portray anything of impulsive nature that we see going further lower. Okay, let me just quickly take a view on the gold for you. Still same picture, you know, our take triangle. This B wave starts to look a little bit of a more complex. Move down towards the end of January, February, and then continue on the upside. Another option, also viable, a little bit lower, below this, invalidates the complete triangle. We have a complex WXY, and then from 1,500, where is this ratio, or 1,600, we continue up in the next leg in the gold. So if you combine all of this data from the macro perspective, because this is definitely looks like a corrective move in gold, as in silver, you can see the picture of possibility of dollar moving lower. Silver looks the same. We have been tracking that also pretty successfully in 2021. So I have here a situation with the silver where potentially we have this B wave going on. We still don't have a clarity if this is the lows. I do see this as a 5 waves up WXY with a little bit lower levels towards March, April, and then reversal with the confirmation with 5 waves on the upside on silver. Bitcoin, if you like to see more on cryptos, we're going to have a crypto lab. Crypto lab will start, I think, 1 hour before than usual, because I have some things to attend in the afternoon, which I cannot expect, which I cannot escape. Sorry. So, yeah, very interesting chart. We have been also, Bennett and I have been going back and forth with this consolidation for the whole year with the different possible outcomes. And we have warned our clients, especially regarding these 2 points where the sentiment was very bullish. Now sentiment starts to be bearish, and I think if you look this weekly 200 moving average and a couple of other indicators, which really kind of works on a higher time frame. So if you look RSI and this type of things, I like to look them on weekly. I still have a triangle. I'm a conservative by nature. I don't want to proclaim or state that Bitcoin will continue towards this, which is around 20 to 22K. I'd like to stay a little bit more in triangle-ish. I'm not doing anything here with the Bitcoin. I'm waiting this situation to be resolved to catch this final move on the upside in the fifth wave. So time ratio works, pattern works, rule of alternation works. So we checked almost all the boxes from the Elliott Wave rules and guidelines in regards of this correction for now. So this is probability is big that this is the fourth wave. We had a wave 1, wave 2, wave 3, and this is a larger consolidation in wave 4, also ending possibly April, May 2022, where we can see the rest of these asset classes completes and dollar possibly move lower. That will not happen at the same time with every asset class. So I'm going to stay with triangle. If we break this 30K support level, that will be huge, because the sentiment on the bearish side will become most negative at 20K, and most of the retail traders will be out, and the picture for cryptos will be dark. So usually when you use Elliott Wave, you want to actually look these swings from optimism to pessimism, and definitely that will be the spot where the picture will be very black, and that will be my point where I will be looked to be engaged on the long side for the Bitcoin. So we will also have next week webinar, which will be a public, dedicated especially to the fundamental and technical side for the Bitcoin. So if you like to see that, just stay tuned. We will publish the announcements and the links that you can register for that event. So that's from me, Bennett. Back to you.
Much appreciated. Thank you so much, Alex. Excellent coverage as always. If you are interested in that event, please tune in tomorrow to the Crypto Lab live stream. We will have the sign-up link provided for you there. You can also check out the channel later on this week. Thank you guys for tuning in, taking time out of your Wednesday mornings to join us. If you're interested, check us out, tradinganalysis.com. We would really encourage it, especially as we enter a year that's going to be a little bit trickier than normal. And then, of course, Alex has been doing a fantastic job on the crypto side. I remember moving into that 65K, 70K area high. Everyone was expecting a move immediately to 100,000. He confidently jumped out, put out the zone of resistance, and said, hey, not so fast. We're up against some resistance that could yield a sizable corrective retracement, and that it has. Terry, excellent work as always. Appreciate it, gentlemen. And if you guys enjoyed the content, please give it a thumbs up. Subscribe with notifications. Lets the YouTube algorithm know that you are enjoying it, and it helps distribute it accordingly. Thanks again. We appreciate it. We'll be back same time, same place next week. Talk to you guys then. See ya.
See you guys.
See you later.
Bye.